Welcome to Wealthy Lead. We are smack in the middle of the biggest gold rush in modern history. But this time, the gold isn't buried in some mountain, it's being built in the cloud. We are, of course, talking about artificial intelligence. Okay, let's just jump right in with a number that sets the stage. In 2025, we're looking at venture capitalists pumping nearly $200 billion into AI startups. Now, to put that into perspective, that is more than the entire GDP of a country like Hungary. It's wild. For the first time ever, AI deals are on track to make up more than half of all global venture capital. So, this isn't just a little trend, it's a massive tidal wave of cash, and it's aiming to reshape the entire global economy. And a number that big forces us to ask what is probably the single most important question for anyone with money in the markets today. Are we actually witnessing the birth of the next fundamental layer of technology, a shift as big as the internet itself? Or are we just riding the biggest, most dangerous speculative bubble ever created, fueled by nothing but hype? That's the core conflict we're breaking down in this explainer. To get to the bottom of it, here's how we're going to tackle this. First, we'll build the bull case, the really strong argument for a sustainable revolution. Then we'll flip that coin and dig into the bear case, all those red flags screaming bubble. After that, we'll look back at the dot-com era for a crucial history lesson before delivering our final verdict. And most importantly, we'll wrap up with a clear, actionable strategy for what to do next. All right, first up, the bull case. This is the argument that what we're seeing isn't just hype. It's a deep, permanent technological shift that absolutely justifies the insane amount of money being thrown at it. So the most important point for the bulls is this. You've got to stop thinking about AI as just another app on your phone. Think of it more like the invention of the railroad, or the electrical grid, or the internet itself, right? Those weren't just products. They were foundational platforms. They were the new layers of infrastructure that everything else for the next few decades got built on. The money flowing in isn't for a fad. It's for a fundamental upgrade to our entire digital world. And get this, unlike past bubbles built on pure hope, this one is anchored by very real, very tangible demand. When ChatGPT launched, it hit over 100 million users faster than any app in history. It's not a case of if you build it, they will come. They are already here by the hundreds of millions, using this tech every single day. That shows real-world adoption on a scale and at a speed we have just never, ever seen before. And what's really crucial here is who is leading this charge. This is not the dot-com era, with unprofitable startups and shaky business plans. The AI boom is being led and funded by some of the most profitable companies on the face of the earth. I mean, look at these Q3 2025 forecasts. $35 billion for NVIDIA, $70 billion for Microsoft, almost $97 billion for Alphabet in a single quarter. These giants are using their enormous cash flows to fund this thing, which creates a much more stable foundation than the speculative IPOs of the past. And this quote just nails the bull case perfectly. It reframes the whole situation. This isn't people trading digital tulips back and forth. It's a massive, front-loaded investment cycle to build new core infrastructure. Think about it. Just like we built power plants to create electricity you can plug into your wall, we are now building data centers and models to create intelligence as a utility. And the ability to plug into intelligence on demand, well, that's a world-changing idea. Okay, that was a pretty compelling argument. But now we have to look at the other side of the coin. Let's switch gears and explore the bear case and see how this whole thing looks like a classic and maybe an incredibly dangerous, speculative bubble. Here it is. This might be the single most terrifying statistic for anyone invested in the AI story. Despite all these billions being spent, a landmark MIT report found that a staggering 95% of corporate generative AI pilot projects have failed to produce any measurable return on investment. Let that sink in for a second. 95%. The gap between the money being invested and the actual value being created, it's not a gap, it's a chasm. And this whole phenomenon actually has a name, pilot purgatory. It's this place where a company successfully deploys an AI tool, they get a chatbot running or an image generator online, but it fails to create any real business value. It's the illusion of progress. The tool can't talk to their inventory systems, or it doesn't understand their product catalog. And at the end of the day, it doesn't move the needle on profits. It's just a shiny new toy stuck in a sandbox, unable to do any real work. And this isn't just a problem for the companies trying to use AI. Even the pioneers are struggling to make a profit. While the big tech giants are making a killing selling the infrastructure, reports suggest a key player like OpenAI is on track for an operating loss of $7.8 billion in just the first half of 2025. I mean, if the companies at the absolute cutting edge, the ones with the best tech and the best talent, are burning cash that fast, it raises some pretty serious questions about the whole business model. So if the profits aren't really there yet, where is all this explosive growth coming from? Well, this might be the darkest secret of the AI boom. A lot of people argue it's just a closed loop, a game of financial musical chairs. Here's how it works. A tech giant, say Microsoft, invests $1 billion into an AI startup. What does the startup do? It turns right around and uses that exact same money to buy cloud computing services from, you guessed it, Microsoft. So now both companies get to book massive revenue growth and their valuations soar. But it's all happening inside this tiny, closed ecosystem. The second that new money from the outside world stops flowing in, the music stops, and the whole thing could just collapse. So we have these two powerful, completely contradictory stories. To figure out which one is right, we really need some context. So let's turn to history's biggest parallel, the dot-com bubble of 2000. Now, while the investor mania feels eerily similar, there is a fundamental structural difference between then and now. The dot-com bust was what you could call a challenger's bubble. It was all about new, unproven companies trying to take down the old guard. The AI boom, on the other hand, is a giant's bubble. It's about the established, powerful companies using a new technology to get even more powerful. And that difference is absolutely crucial to understanding the risks we face today. Let's just break this down. In 2000, the leaders were these emerging challengers like Cisco, and most of them were wildly unprofitable. Today, the leaders are cash-rich giants like NVIDIA and Microsoft. Back then, the money came from speculative IPOs sold to the public. Today, it comes from the giants' own massive bank accounts. And look at adoption. Only about half of US households were even online back in 2000. Today, enterprise adoption of AI is already over 70%. Here's the scary part. A crash this time around could be far more severe. The dot-com bust wiped out the challengers, but the core economy was basically fine. A crash today would mean the pillars of the S&P 500, the giants themselves, would crumble, and that could trigger a systemic macroeconomic crisis that hits everyone. Okay, so we've heard the bull case, the bear case, and the echo from history. It is time to bring it all together and deliver a verdict. Is it a revolution or is it ruin? Well, the answer is, it's both. This is not a simple yes or no question. We are absolutely witnessing a genuine, fundamental technological revolution. The technology is real, its potential is immense, and it will change the world. However, that revolution is currently taking place inside a massive, industry-wide valuation bubble. The market's price tag has raised way, way ahead of the technology's current ability to create real, measurable economic value. The hype has simply outpaced the reality. So what does the future hold? We see three likely scenarios playing out over the next few years. First, you have the Great Market Shuffle, a sharp, painful 30 to 50% market crash that just wipes out the weaker players and lets the giants consolidate even more power. Second is the slow plateau. No big crash, but years of stagnant, sideways market action as the economy slowly grows into these huge valuations. Or third, the hype continues. Maybe a new breakthrough like GPT-5 is a true game changer, and it just reignites the whole cycle, kicking the can further down the road. And this brings us to the biggest systemic risk, what a potential cascade failure could look like. It starts with the technology plateau. The next generation of AI models are just a little bit better, not exponentially better. This causes investor confidence to just collapse, and the giant tech stocks correct hard. Because their spending has been propping up huge parts of the economy, they're forced to slash their spending. That cut triggers a real macroeconomic recession. In response, venture capital funding freezes solid, starving thousands of startups of cash. And in the chaos that follows, you can bet regulators will step in with heavy-handed rules. A simple technical disappointment could spiral into a full-blown economic crisis. That all sounds pretty grim, I know, but understanding the risks is always the first step to managing them. So let's move to the final and I think the most important section, our strategy for navigating the hype, whether you're an investor or a business leader. For investors, the playbook is pretty clear. First, and this is the most important thing, just acknowledge the bubble exists. Price that risk into every single decision you make. Second, shift your focus away from startups with a great story to companies with actual revenue and proven product market fit. That means they're solving a real problem that customers are willing to pay for today. Third, be disciplined on valuation. Do not pay a crazy premium for pure hype. And finally, if you want long-term exposure, maybe consider the picks and shovels of this gold rush, the infrastructure layer like semiconductors and data centers. they hold value even if the apps built on top fail. For business leaders, the advice is just as critical. Please, avoid AI for AI's sake. Every single project has to be tied to a clear business goal and a measurable return. Focus your limited resources where the return is highest, which is almost always on back-end automation. Things like optimizing supply chains and finance, not necessarily a flashy marketing chatbot. The key is to re-engineer your core processes for AI, not just staple AI onto your old way of doing things. And finally, treat this as a strategic challenge about people and process, not just some tech project you can hand off to the IT department. And that leaves us with the final critical question. We are in a bubble, and all bubbles eventually pop, or at least deflate. The only question that really matters now is, when that happens, which companies, both the startups and the giants, have the financial discipline and are creating enough real-world value to survive what's coming. That is going to be the great separator of the next decade. To continue getting analysis that cuts right through the hype, make sure you subscribe to Wealthy Lead.